In 2025, over 90% of actively managed funds underperformed a simple index fund. Not 50%, not 70%, 90%. And here is what makes that number truly extraordinary. It has barely changed in 30 years. Wall Street employs the smartest analysts in the world, armed with the most sophisticated data tools ever built. And 90% of them still cannot beat a fund that simply buys everything and does nothing. Today, we are going to explain exactly why index fund investing still wins in 2026 and why a $500 investment beats most hedge funds over time. Before we get into the numbers, let us make sure we are clear on exactly what an index fund is. An index fund is a type of investment fund that tracks a market index, like the S&P 500, by owning every stock in that index. The S&P 500 index includes 500 of the largest publicly traded companies in the United States. When you invest in an S&P 500 index fund, you own a tiny slice of all 500 companies simultaneously. Nobody picks the stocks, nobody times the market. The fund simply mirrors whatever the index does, up or down. This is called passive investing, and it is the single most effective long-term wealth building strategy ever documented. Now let's understand the battle. Active investing versus passive investing. This has been one of the most studied debates in all of finance. Active investing means a fund manager studies companies, picks the ones they believe will outperform, and tries to beat the market. These fund managers are typically paid significant salaries, and their funds charge investors fees that reflect that cost. The average actively managed fund charges fees between 0.5 and 1.5% of assets per year. The average S&P 500 index fund charges just 0.3 to 0.03% per year. The Vanguard S&P 500 index fund charges just 0.03%. That's $3 per year on a $10,000 investment. Now, let's look at the actual data, because the evidence against active management is not an opinion, it's a documented annual study. The SPIVA scorecard, published annually by S&P Global, tracks the performance of actively managed funds against their benchmark index. The SPIVA report is the most comprehensive study of active versus passive performance ever conducted. It covers thousands of funds across decades. The 2025 SPIVA results: over 1 year, 64% of large-cap active funds underperformed the S&P 500. Over 5 years, 78% of large-cap active funds underperformed the index. Over 10 years, 87% of large-cap active funds underperformed the S&P 500. Over 20 years, 92% of large-cap active funds underperformed the index. The longer the time period, the worse active management performs relative to the index. This pattern holds across every time period studied. So why does active management fail so consistently? There are 4 specific reasons, and they compound against each other. Reason 1, the fee drag. Every dollar paid in management fees is a dollar that doesn't compound. Fees create a permanent performance deficit from day one. A 1% annual fee on a $100,000 investment costs approximately $30,000 over 20 years, assuming 8% returns. Reason 2, the market efficiency problem. In 2026, financial markets are the most informationally efficient they have ever been. Thousands of professional analysts study every major stock simultaneously. When information becomes available, it's priced in within seconds. In a market this efficient, consistently finding mispriced stocks before thousands of other professional analysts is nearly impossible. Reason 3, survivorship bias. The funds that appear in performance rankings are only the ones that survived. The ones that failed were quietly closed and forgotten. When you see a fund with an impressive 15-year track record, you're not seeing all the funds that started at the same time and quietly failed. Reason 4, behavioral drag. Fund managers are human. They're subject to the same psychological biases that hurt individual investors. overconfidence, loss aversion, herding behavior, career pressure to avoid being different from peers. These biases cost active funds performance every year. Now, let's show you the math, because $500 invested in a simple index fund beats most hedge funds, not in theory, in practice. In 2007, Warren Buffett made a famous 10-year wager. He bet $1 million that a simple S&P 500 index fund would beat any basket of hedge funds. The hedge fund side selected a basket of funds managed by some of Wall Street's most respected professionals. After 10 years, the simple S&P 500 index fund returned approximately 85%. The basket of 5 hedge funds returned an average of approximately 22% over the same 10 years. The simple index fund beat the Wall Street professionals by more than 60 percentage points over 10 years. Buffett won, and he donated his winnings to charity. The lesson was more valuable than the $1 million. Now, let's make this real for someone starting with just $500, because you don't need thousands to begin. $500 invested in a low-cost S&P 500 index fund in 2026 at a historical average of 7% after inflation grows to approximately $2,700 in 20 years. In 30 years, that same $500 becomes approximately $5,300. But here is the real power. $500 a month invested consistently grows to $340,000 in 20 years. $340,000 from $500 per month in a fund that charges $3 per year on $10,000 invested. Meanwhile, the average hedge fund requires a minimum investment of $1 million just to get in the door. The index fund has no minimum beyond the share price. Many brokerages now offer fractional shares, so you can start with literally $1. Now, let's address the question that is on everyone's mind in 2026. Does index fund investing still work when markets are this volatile? In 2026, global markets are experiencing significant volatility driven by tariff uncertainty, geopolitical shifts, and AI-driven market disruptions. Many investors are asking whether this volatility means they should switch to active management, funds that can theoretically move in and out of positions to avoid downturns. The SPIVA data answers this directly. In years of high market volatility, active management performs worse relative to passive, not better. Why? Because volatility triggers the behavioral biases that hurt active managers most: overtrading, panic selling, herding with other funds. The index fund doesn't panic, it doesn't overtrade, it doesn't have career pressure to explain underperformance to clients. It simply holds. History confirms this. After every major market crash in history, the S&P 500 has recovered and reached new all-time highs. The 2000 dot-com crash, the 2008 financial crisis, the 2020 pandemic crash, the 2022 bear market, recovered from all of them. Now let's talk about how to actually start, because the strategy is only valuable if you implement it. Step 1. Choose a low-cost brokerage. In 2026, Fidelity, Schwab, and Vanguard all offer zero-commission trading and fractional share investing. Step 2. Select a broad market index fund. The S&P 500 is the most proven. The total stock market index gives slightly broader diversification. Check the expense ratio before you invest. You should be paying no more than 0.2% annually, and ideally 0.03 to 0.1% annually. Step 3. Set up automatic monthly contributions. Even $50 or $100 per month invested consistently builds serious wealth over time. Step 4. Don't touch it. Don't check it every day. Don't react to market news. The strategy only works if you stay invested. The biggest enemy of index fund returns is the investor who sells during downturns and misses the recovery. The fund is not the problem. The behavior is. Here's what I want you to take away from this video. Index fund investing is not exciting. There's no story, no analyst picking the next great stock, no clever market timing. And that's exactly why it wins. Because in investing, boring is profitable, exciting is expensive. In 2026, with markets volatile, AI disrupting industries, and economic uncertainty high, the temptation to find a smarter strategy is strong. The data says resist that temptation. The evidence is 30 years deep. 92% of active funds fail over 20 years. The index keeps winning. $500, a low-cost index fund, automatic monthly contributions, time and patience. That's the formula. Not glamorous, not complex, not exciting, just demonstrably the most effective long-term wealth-building strategy available to anyone. If this gave you one idea worth acting on, subscribe. Every week, we break down the numbers, systems, and frameworks that build real wealth. See you in the next one.